Good afternoon. It's Chris Robinson, Robinson Ag Marketing with today's post-close grain and livestock comments for Wednesday, June 24th. 6 more days till we get hopefully some relief with some good news from the USDA about corn acres. Um, we kind of find out together, new crop corn just fell to a new contract low, 434 and a quarter. We settled at 434 and three quarters. What's the culprit? Just, no buying. We had the one little blip about China last week. Looked like they might step in and buy more. They have not. They have gone to the sidelines again. Spot corn, July corn. For about a month now, we've talked about the possibility that we go down and get this gap on the weekly nearest chart. I've had it in the letter probably since we dropped through 440 back on June 6th. June 3rd. That week there where once we went through 440, that started being a possibility. So 405 and a quarter fills the gap. Today's low was 405 and three quarters. I can't imagine we're not going to go down there and probably test $4. It's a big psychological target now. So we had hoped that we get some buying to step in. This is exactly why we did not lift puts, even though it was very tempting when we bounced from 406 to 420. So we've maintained puts on our run price bushels, and we're going to have to hunker down. This is like being in the trenches. July beans, 1107, down 8.25 cents today, settled at 1108 and three quarters. Again, just not enough buying showing up. Now, the big number to watch in July spot beans is going to be 1102 and a half. If that doesn't hold, you could get some more long liquidation. The funds were still long beans as of the last USDA report. That may be the last shoe to drop. There's big support if you take the yearly move in July beans from 1023 up to 1223. $11 is 62% retracement. That's going to be a big battleground. So we're back to following the technicals. I know how much we all hate technicals. We've been stuck trading them for a while here right now. July wheat a little bit lower on the day. Did not take out the low of the flush, which was 571. That's where we were on June 15th. We did finish today at 585. However, this is Wednesday. If we don't get some buying showing up, you could get some more pressure down to those lows. So it feels like that's what we want to do. Again, I don't hate to be a dead horse. This is why we did not lift puts. This is why we rolled puts down. We still have our puts in place for unpriced bushels for both new crop corn and old crop corn, and for any unpriced bushels. November new crop beans. Well, I've talked about this level for months and months as well. This 1135. This is the halfway back level. We have not yet challenged the June 15th low at 21 and three quarters. We did hit 35. So that's going to be the big thing. Is there another 10 cents to go? Our beans going to go retest that 21 level. We'll have to wait and see together. Again, this is why we didn't lift our puts. We're going to hold on to those puts because we do not want to sell cash bushels into new lows. The puts are there to prevent that. Moving over to the protein complex, higher on the day, although once again, just sluggish. A $2 range in August fat cattle. Couldn't get above 248. There's all that resistance there at 250. We did at least find support, at the 246 area, but it's hard to do much with cattle at a $2 range. August feeder cattle, a $7 range there from 67.75 to 75.40. We did finish up $4 there on the day. Again, what are we watching? We're watching to see if feeder cattle can push through the old high there, which is at three. I'd say the next level I'd watch would be the 378. I've had that in the letter as well. You go back to 375 and change, which was the high in October. Let's see, trying to read this here correctly. Yeah, 375 and a quarter is what I'd be looking at. I'm doing this kind of on the fly. It is all these levels are in the daily letter because I go through there and double check them. 375, 378, and then 379 half. We did poke our nose above 375 today, but then fell back. So it also just feels like the whole world is not interested in trading grains or livestock right now. It's like that we've taken a breather. We're halfway through 2026, and I think a lot of people, especially the speculators that were long and excited about possibly having a bigger grain market, they've all left the market now. So I call them the tourists. The tourists have left. You had crude oil go back down to where we were right before the war started. Go back to June 28th. We were trading right around here, 69.63. That was the low today. We're trading at 70 bucks. So the entire crude oil premium story is pretty much gone by the wayside. There, that gap gets totally filled in crude oil at 67.83. Today's low was 69.63. You know, is that close enough for horseshoes? I don't know. I think that that gap is too tempting. Just like the gap in spot corn at 405 and a quarter. So, wish I had better news. We're going to have to keep our eyes and ears open moving ahead towards June 30th. Right now, this is shaping up to be looks just like 2012. We slid all the way into the June 30th acres report of 2012. Of course, in 2012 we had the drought. Right now we don't have the drought. We've got too much rain, right? So that's the new narrative. Did too much rain give us a bad root structure, and then somewhere down the line, if we get heat, will that lower yields? So if you're bullish, you need one of two things or a combo of both. And I had this in the letter last night. You need less acres and preferably over 2 million less acres of corn. And you also need less yield. That's the only thing that's going to turn around this boat. All right, this is Chris Robinson, Robinson Ag Marketing. If you need help, give me a call, 312-638-8868. The one silver lining, if you're an end user, right, the calls just got cheaper. And if this is set up for some sort of recovery um, in July and August, the calls are on sale. And again, the same people who were extremely bullish 70 cents ago in corn are now getting very, very, very bearish. Do not let your emotions get the better of you. Try and keep your risk on paper. Try and stay in good position. We want to be in good position so that if we do get a rally, we're in a position to reward it. Now is not the time to be selling two calls to buy for a put, to pay for a put. Maybe a great strategy because you want something for free. But boy, if this market turns around, the last thing you want to do is cap your upside if we do get a recovery. All right, this is Chris. Have a good night. Like I said, I wish I had better news. I'm right there with you, hoping for a recovery.